thanks for sticking around, and this is part 2, and we're going to pick up exactly where we left off, and thanks for being here. Yeah, I want to get into that in just a minute, but I want to kind of change gears.
Sure.
And it ties into into your top 5 and what's going on right now. And there's been a market sell-off in the equities markets, as you're well aware, and I believe that they're actually down today as well. And,
oh yeah.
But so you've got your top 5, but we're in the middle of this market sell-off, which I don't know if this is quote the end, because I keep reading on Zero Hedge about the end of the dead cat bounce and all this nonsense. So how do you see this market sell-off right now, Lior, as far as the in particular in relation to your top 5?
Well, I was 16 in the dot-com bubble. I imagine that you have a very vivid memory of what the newspapers were saying back then, and what TV was saying, and what was the sentiment towards stocks leading up to 2000. This is not the sentiment right now. If you remember, in January of this year, January 2018, I believe it was CNBC that put out a tutorial, an entire series, how to buy Ripple. And a week later, it was the top of cryptocurrencies. And so in the top, when markets are topping off, there's euphoria. Mainstream media is going to do articles like the American resurgence. Don't miss out on buying Apple before it's a $2 trillion company.
Right.
And this is not what we're seeing right now. And right now we're seeing market turbulence, all sorts of very, very bearish and warning signs. So this is not the end, not by a long shot. What we're seeing right now is a very healthy and very predictable correction in the stock market.
Okay.
October, I remind everyone that October is the most volatile month of the year, going back to 1896 when the Dow Jones was invented. And so you're talking about 120 years worth of research. This is the most volatile month by a factor of 37%. And I remind everyone, 2008, it was the Lehman moment was in October. 1987, Black Monday, October. The Great Depression, October. So October is a very, very volatile month for stocks. And one of the things that has very much categorized this bull market is a large amount of share buybacks by CEOs. This is earnings season right now, so they can't be buying back their own shares. And therefore, this is obviously impacting the amount of volume and buyers in the market.
Right.
So this is another thing to keep in mind. I can give you 3 other factors, technical and fundamental, that will, what I'm trying to say is not that this is the buying opportunity of a lifetime, but just to understand that this is not the market top. This is not the top of the market for this cycle. Now, I'm not an index investor. I'm a stock picker. I pick certain specific stocks, and therefore I look at specific companies and decide whether or not this is cheap enough for me, and do I understand the company enough that there's a big enough margin of safety with the price that I'm willing to pay for the company. But in terms of the overall market, the overall S&P 500 and the Dow and the Nasdaq, the P ratios are quite elevated. But compared to the interest rates offered by bonds, it's not enough to cause investors to change into bonds. You'll probably need to see the 10-year Treasury at about 4 to 4.25% in order to make enough of a alternative so that investors would say, hey, The S&P 500 is projected to make about 5%, Rory, by from now to 2028. So for the next decade, this is the projection of the S&P 500, about 5% a year, very low. And inflation is projected to be around 3.5% officially. So you're taking a lot of risk being in the stock market for only 1.5% adjusted for inflation. On the flip side, if the 10-year Treasury can yield about 4.5%, then that is where it's much safer, right? For almost the same amount of return,
Right.
adjusted for inflation, you can lend the U.S. government money instead of investing in stocks that can endure very problematic corrections, sell-offs, panics, etc., etc. So it takes a little more for investors to start switching gears. Now, if both of these choices didn't sound that juicy to you, it's because they aren't. And therefore, in an environment where there's higher inflation, lower projected stock returns, and basically very normalized bond yields, investors tend to go to the third option, which is commodities. And therefore, once you see this market top, and this can happen in about a year and a half. This doesn't have to happen soon, because 4 to 4.25% for the 10-year Treasury means about 6 more hikes at this point. At a 25 basis point rate, that they can obviously increase it to 50 basis point in one rate, in one hike, right? So that is something we're doing and we're looking at. But yeah, commodities, in terms of what's going to be attractive, this is something that's going to be very attractive. Right now, we're in a bear market for commodities, and therefore, for your show, for your listeners, which I know are very sophisticated, and they love controlling their portfolio during a bear market, we created 11 strategies to control your finances in a bear market, and you can go to wealthresearchgroup.com/bear. It's our number one most downloaded report.
Wow.
Because it goes over 11 strategies on how to control your finances in a bear market, which is very, very important, because you want to have a chance for profits in a bull market. But unless you make really good choices in the bear market, you don't have a prayer. And so, if we're talking about the historical precedence of what's happened in the last 2 weeks here, Rory, the S&P 500 has gone down about 4 standard deviations from its in one day. That happens about 1 in every 10 years. Now, when it does, it usually, so in every other time it happened, until besides this one, which hasn't had the opportunity to prove itself, but for the every time previously that has happened, in 3 months we've seen a new all-time high for the indices. So I'm looking at new all-time highs for the Dow, the S&P, and the Nasdaq by January of 2019.
Wow, that's a bold statement. I like it. I mean, I'm not challenging.
Check me in January.
I mean, obviously you've got the data that makes you confident to make that statement.
Rory, here's another thing, if I may, the midterm elections. So, yes. Historically, going back to the start of the Republic, every midterm elections have marked the beginning of the best 9-month period for stocks.
Really?
So, yes. So from the midterms, when it's decided who's going to be the party that takes control of the Congress, the best 9-month period starts for a bull market. The best combo is a Democrat president with a Republican House, and the second best combo is a Republican president with a Democratic House. Now, coming in third is a Republican. So a Republican president, Republican House, and the difference is very small between them. And so what we're looking at is a very good period historically for stocks. Now, why is it a very good period? One, there is no uncertainty, right? We know how politics will look like for at least 2 years, right? So
Yes.
certainty is something that investors love. Secondly,
Makes sense.
new policies are enacted immediately. So if the Republicans win the midterms, you're going to see more tax cuts, more deregulation, more of Trump, and
Right.
people are the economy is absolutely in love with Trump. If you're going to see the Democrats win, you're going to look at probably a vast infrastructure program, resurgence in the Rust Belt, private-public partnerships. So basically, the government going in and telling banks like J.P. Morgan, hey, you need to go into these areas where there are many unbanks, and you need to start engaging your community and getting people to to have bank accounts and to start creating a credit cycle here. And you're going to see them go into real estate companies, home builders. They're going to free up more land, put people into jobs. And so whatever it is, whoever wins, the economy stands to gain from this. Now, I do want to caution that there are two economies in the U.S. right now, one for the public sector and one for the private sector. And when I say public, I mean the federal government. The federal government is a huge black hole of unfunded liabilities,
Yep.
which you're going to have to tackle. In the next election cycle, I think one of the focal points will be Social Security, Medicare, and Medicaid. There's no doubt that in 2020, there's going to be a lot of talk about how America faces this cliff of very unsustainable expenses that they need to make. Because if foreign investors, if foreign governments stop coming to the bid, to the auctions, and they don't want to lend the U.S. economy, the U.S. Treasury any more money, or they want higher interest rates, or there's just not enough bidders at the auction to fund the deficit, the Federal Reserve has already proven that it doesn't want to do that anymore. So you're not going to see any more QEs. Now, if you're not going to see QE, who can fund a federal deficit? And the answer is the federal government can do that. It can print currency. Different from what the Fed does, to where it creates credit, buys treasury bonds, and therefore funds the government indirectly, which can happen with very low inflation rates, as we've seen in the last 10 years. Printing currency outright is highly inflationary, and the U.S. hasn't had to resort to this in a very long time. If they would, so in other words, if it becomes politically impossible to lower the entitlements or to postpone the entitlement age, or to make it very very hard to get your entitlements, telling people, hey, you need to keep working if you want your social security check, so you need to show us a pay stub. All these sort of blocks around getting your Medicare and Medicaid, etc. If they don't have a political way of doing that, they'll need to print currency, and that's going to be very inflationary. And that's the wild card, Rory. If they need to do that, so many things are happening. The private sector flourishing. Companies are having a lot of cash on hand, and they're enjoying a global economy. But for the federal government, big problems. Pension funds, big problems, and it's a huge overhanging cloud. And then the second way I think that the United States is a twofold economy is the fact that the top 1/10 of 1%. So if you take a cut of 1,000 people, Rory, the richest person in a 1,000 people cut is richer than the bottom 900 people combined.
Yep.
And that is a situation that is very normal for the rest of the world, very uncommon for the U.S. So in the rest of the world, you can see that in just about any other country. There's a huge wealth gap. But the United States has always prided itself on a very flourishing middle class, at least since the Second World War. So in our lifetimes, and now it's not happening. So
it's moving in the other direction, actually.
Yeah. And we created two very, very detailed report on this. If you go to wealthresearchgroup.com/attack and /drama, then you can see two very, very detailed reports on some of the things that are going on right now with the middle class, where the middle class will be in a few years' time, and what people can do to offset the inevitable causes of capitalism, which is creating a situation that if the United States doesn't subscribe to the idea that they need to compete on quality and not on wages, they can't be the lowest cost producer. They can only be the top quality producer for the rest of the world. There are 48 countries that have a cheaper manufacturing base than China.
Wow.
And therefore, the United States cannot be the low-cost choice for the rest of the world, but it can be the best value add. In other words, the country that makes the best finished products and has the highest intellectual properties. If they don't do what what the globalists have done for 30 years, and that's basically outsource everything at a very cheap cost, basically getting getting sucked dry. And
And
what
in the
what I love
process,
about Trump is that he doesn't let that happen.
right, and in the process of this globalization, they've stripped out any semblance of quality. And I think
Exactly.
that I agree completely with what you're saying, because people, what I see and hear every day is that people are just sick up to their eyebrows of these cheap quality manufactured goods, whatever it is. It doesn't matter what it is. I mean, yeah, you're always going to have people that's all that they care about is what's the cheapest one I
Sure.
can get.
Sure.
But they're not the majority of the market,
No.
and the
Well,
majority of the market.
obviously they're not the majority because I don't see a lot of people buying the cheapest car, right?
Right,
Or the
exactly.
cheapest anything.
The cheapest anything, because and that's what people want. And I see I think that's one of the biggest uh, problems that globalization has brought about, as far as from the manufacturing side. And it's you've been talking about a two-tiered, or two completely separate
Two economies
economies.
within one nation.
Yeah, and while I agree with that, I'm curious as to your take on the private sector economy, because I see it as being more of an illusion than anything with the corporate stock buybacks. I've talked about that for the past 4 or 5 years, and that being just a huge problem. I said that 3 or 4 years ago to a couple of different people, and they poo-pooed the whole idea and said, no, it's not a problem. It's like, well, it's going to be a problem. Might not be today, but it's going to be. And now I think that we're starting to see that is, in fact, a huge problem, because if you're just buying your stock instead of reinvesting into the people and into the equipment and into the research and development of new products, well, everything's going to start suffering. And now that's where I believe that we're starting to see some of that in the economy. And also, Lior, I mean, the unemployment numbers that are touted, they're not realistic, according to John Williams over at Shadow Stats. I mean, none of this, the inflation is not real. None of it is real. So how does that play into your line of thinking? Or does it? Or does it even matter? I mean, as far as from
Well,
an investment perspective.
that's let me answer that, and it's a great question. So currently, there's about 156 million people in the U.S. workforce. That's the total civilian non-farm labor force employment, which means that not in the workforce, there's 96 million people.
Right.
And that's a lot of people.
A lot.
For a country that has 328 million people, 96 million people constitutes around 30% of the country that is not employed. So when you say there's a 3.9 or 3.8% unemployment, what it means is that out of the 156 million that are employed, There are 6 million that are officially unemployed, and actually there's about 12 million unemployed if you count part-time people or people that are basically in sort of a situation where they're transients. So in terms of those people, there are about 7 million openings right now. So if they were skilled enough to work the openings, there will be zero unemployment. But still, it means that that there are 96 million dependents on the government.
Right.
So, the unemployment rate, it's important to understand that it's out of a pool of the people that are in the workforce. And that's an important distinction to make. Now, when it comes to two economies and everything we're saying, some of the biggest companies in the United States are companies which have a headquarters in the United States, but not their main hubs. So that's another critical thing to understand. A company like Procter & Gamble that sits in Cincinnati, that's the headquarters, but they have most of their operations outside the U.S. Even an American Hallmark, McDonald's, 65% of their income comes from Europe. So, it's important to understand that the United States has become a place where quality workers are at the top of management teams for multinational companies, but domestically, there aren't a lot of manufacturing jobs, as we know,
right.
And there's not a lot of growth in terms of traditional businesses. What is growing is high-tech companies. So, and these are only certain pockets of the economy. And so, if you're looking at the broad economy and you're telling to yourself, okay, can I, as the average person, work for Apple one day, or for Amazon, or for Google one day? The answer for the average person is no, because tuition has been so subsidized by the government that many people cannot even afford tuition. And therefore, if the government wants to do a favor to the citizenry, it should get out of the student loans business and let tuitions come down to earth.
Right.
Because it doesn't take that much money to employ professors and to run the gardening of all the grass on campus. It's not that difficult.
Right.
And to maintain these buildings. And honestly, in the online era, you can sit at home and study. So if the government would get out of the student business, you'd have much more people that are trained, and you'll have 10 companies the size of Apple. The brains in the United States is still number one in the world. The human potential is still number one. The business environment is still number one. And the free market economy is still number one with all its ailments. And therefore, if the government can do one thing, get out of the student loan business, stop harassing the free market, and let it move forward.
Right. I think Trump is trying to do that. I think that he's been attacking the regulations. He's the first one in a number of years that has been eliminating regulations to get government out of the way of business. And
Sure.
And I agree completely that the student loan, that whole thing is it has turned into a nightmare. And the only thing that's grown at any of the universities is the admin staff. The value that they bring to the table has shrunk greatly. Sure. It's diminished. I mean, it's all but gone at this point. I mean, a BS or a BA, those are just about as they hold about as much value today as a GED, in all honesty, because the market's just saturated with them. I mean, seriously. Yeah. Or am I wrong?
No, I think, look, the government should stay out of it, and it should let the free market do what it needs to do, because
exactly.
In our world, people need to get retrained about 3 or 4 or 5 times between the times they're 20 and 60. So people don't stay in the same jobs and even in the same professions for 40 years. And for companies to make it for it to be affordable to take a 40-year-old or a 45-year-old and put him into retraining, you need to lower the cost of education. Because this person needs to go back to school, or he needs to work out a plan with a new employer that he gets on a training program, and these programs need to be affordable. It's a huge question. It's a huge problem. Not very easy to tackle. It's something that needs to be put lots of thought into. But the people that are in charge of it must think about the ramifications of what's going on, because you don't want people that are permanently displaced at age 45, because you're going to have universal income in 20 years if that happens.
You got that right. We might have it in 20 years anyway, regardless of any of that. I mean, if the socialist maniacs get their way, then we will.
It's just important. It's just important to make sure that people have opportunities instead of becoming people that are dependent. They don't want to be dependent for the most part. They want a productive life. They want more out of life, and they want to be contributing. We all want to be moving forward every single day. And therefore, it's all a question of organizing, and it's a question of making sure that we're not trying to be popular, but we're trying to be efficient. So, this is where the United States economy faces off its biggest threat right now. It needs to figure out how to revive the middle class and the domestic economy, because the multinationals are thriving, but there are many people that are stuck in careers and career paths that are not promising, to say the least. What the U.S. does have in its favor is a very early stage of a demographic shift for the growth of the millennials, and Rory, they don't have, for the most part, they don't have cars, don't have houses yet, and they haven't started taking on vacations or making big splurges. So there's a huge surge ahead of us in terms of demand for everything, from housing to cars to vacations to home entertainment, etc. The U.S. economy will keep growing at a 2.5%, 3% pace a year, which will add about $100,000 to every family in America in one generation. So on average, people will have about $100,000 more of equity in 25 years from now. So the economy overall will keep growing. Will keep growing beautifully, but you have to make sure that you're within the surge. This is not a rising tide lift all boat. If you see one person like Jeff Bezos that has 140 billion, while the minimum wage in his company is $15, you can really understand that we're moving into an economy where certain skills are so highly valued that the rest of the skills are becoming mundane. So, and that's the problem with the wealth gap. So, creating opportunities for other people to get involved in the economy is critical. So we don't have a situation where it's becoming very disingenuous for many people to live in America.
Right, and creating opportunities for ourselves.
Exactly.
As I described a minute ago, that I worked for Cardinal Health, 15 or about 12 to 14 years ago. Not doing that now. What I was doing there for that company is very different from what I'm doing today. I wasn't interviewing anyone when I was at Cardinal. And today,
definitely,
that's,
you need to reinvent yourself.
And that's exactly what I did. And a lot of people are going to have to do that. They're going to have to find something that fits their life and that will generate an income for them, because they're just not going to, working for Amazon for $15 an hour is not going to do it. It's just not. Well, Lior, the market, there's a lot of problems, as we both know that we've been identifying. There's a lot of opportunities, and that's one of the things that you have been focused on, is bringing those opportunities and making sure that people have a better way of looking at things. At least you're at least providing them a window to look through and to see if something will fit with their goals. I mean, you've given 4 or 5 different reports that you've got, all of which are linked in the description box below the video. So please check out those all those reports that Lior put out. They're all free. He doesn't charge for any of his research. And make sure you subscribe to the newsletter that he puts out every couple months, so that you can find out more about his investments and where he's at. Just like in
Sure.
the first
The
part of the
newsletter
show.
goes out 3 times a week.
Okay.
But this publication of the portfolio update is a 60-day occurrence
Okay.
cycle within the normal publication. So we publicize 3 times a week, focusing on the general economy and what's going on right now. Like we said, interest rates, the Fed versus Trump. We cover what's most important right now. It's my way of getting basically what's going on in my head to the readers.
Okay.
And then the added layers that we have, specific opportunities that if I find something very interesting, then we feature it in the newsletter. So we're not just generic, but we're also specific.
Okay. I like it. And you can find all of this over at wealthresearchgroup.com. Lior, thank you for all your time today. I really appreciate it. It's been a great conversation, and I look forward to speaking with you in the not too distant future.
Rory, thank you, sir.